It takes a licking, but keeps on ticking. Some of you are old enough to remember that iconic slogan from Timex watches, but as it turns out, many are saying the same thing about gold. Before we begin, remember to like this video and subscribe for more economic updates. Since gold started moving up towards the end of February, it doesn't seem like any economic data, good or bad, can stand in its way. Recent economic numbers suggest interest rates could remain at their 23-year highs for at least several more months, as tensions in the Middle East appear to have receded for now. Yet, despite what are traditional headwinds for gold, gold continues to demonstrate impressive resilience, climbing 15% over the past 8 weeks and remaining well above $2,300 per ounce. Many analysts say one of the reasons that gold has been so durable this time around is the breadth of fundamental drivers that have been supporting the metal. Among them are inflation, recession fears, de-dollarization, fiscal instability, and worldwide geopolitical uncertainty. And now, in the wake of new economic data released in the last several days, analysts are suggesting that yet another fundamental precious metals driver could be on the scene: stagflation. Broadly defined, stagflation is an economy categorized by the simultaneous occurrence of two conditions that aren't supposed to exist simultaneously: low economic output and higher inflation. And last week, the Commerce Department delivered news hinting that stagflation might be on the way. According to the agency's report, real GDP grew at just 1.6% in the first quarter, while core inflation clocked in at 3.7% for the quarter. In response to the data, David Donabedian exclaimed, "This was a worst of both worlds report. Slower than expected growth, higher than expected inflation." As a description of stagflation, that is nearly perfect. But imagine this: stagflation is like a double-edged sword for the Federal Reserve. The inflationary components make it nearly impossible for them to lower rates, but the recessionary components make it nearly impossible for them to raise rates, so they're stuck. And if the situation goes down that path and gets worse, it might force the central bank to take extreme measures. In the 1970s, a serious bout of stagflation forced then Fed Chairman Paul Volcker to raise interest rates to 20% to eradicate the double-digit inflation plaguing the country. The draconian step plunged an already fragile U.S. economy into a deep recession. One silver lining of that period was the performance of precious metals. For the decade, both gold and silver moved substantially higher, outperforming all mainstream assets by a significant margin. As for why stagflation can serve as a strong driver of gold, PhD economist Eric Ciron explains, "When attacked by two enemies at the same time, most assets become vulnerable, and gold tends to outperform them. This is not surprising, as during stagflation there is a huge amount of economic uncertainty. Confidence in the central bank is low, and real interest rates are on the decline." In other words, Ciron adds, stagflation makes gold's fundamental factors bullish. In fact, research published in 2022 by the World Gold Council revealed that since 1973, stagflationary environments have been the most supportive for gold and the worst for risk assets. In the world we live in, 2 + 2 doesn't equal 4 anymore. And a GDP report showing that stagflation might be coming doesn't mean it will. Gold performing strongly during stagflation in the past doesn't mean it will today. However, gold has a track record of strong performance during challenging economic times, and stagflation is one of the most challenging.